So over here, this is a crude depiction of a daily chart. Okay. Now, each one of these candles represents one day, and the idea is that we're seeing a market that's been going higher, and the market has traded lower here since this candle here. It traded lower. In the next candle, we worked inside the upper portion of the down closed candle. That's a bullish order block. So that high, or the opening price, extended out in time. As long as we're trading below that, while it's bullish, we have a swing high here. So there's buy side liquidity resting above that. So the framework will be buying inside this down closed candle, expecting range expansion on the upside to trade above this short-term high for buy-side liquidity. That is the easiest, most simple, direct bread and butter setup that I basically outline in my free content on the YouTube channel. But I'm going to show you how you can take this rough depiction here and apply it to any of the approaches of trading. But for now, this is a simple short-term trading to day traders model. And the expectation, again, is on a daily chart, this candle here, before it forms, we have already created a swing high. In other words, imagine this candle hadn't started yet. So this candle closed down, and we're waiting for the new trading session to begin. So the next candle, it opens, and we're in here. Now, some of you may say, well, the candle wouldn't open like that. You don't know that. This could be a Sunday, or it could be a Monday, or it could be a holiday. It could be anything. Okay, so don't try to read too much into it and play quote-unquote devil's advocate here. I'm giving you the framework on how you need to outline the model that makes sense to you, or what it is you're looking for. Okay, what provides the framework for a setup to be even considered. Okay, so we know we have a swing high here. We know we're expecting price to go higher. Okay, that's the crude depiction I'm illustrating in here. And what do we reach for? Premium arrays. So we have an old high. What's above that? Buy side liquidity. Now this could be just as well something over here to the effect of relative equal highs, or it could be an imbalance up here that it could be reaching up into. I'm just keeping it as bare bones simple as you can possibly make it. It's an old high after a swing high is formed, and it's likely to go higher because retail would see that swing high as a top, and we like to see those things get ran out. And that expansion in here on this particular day, over here, this day may form on intraday data a 15 or 5-minute relative equal high inside this one single candle, which would be represented like this. Okay, so this over here is this candle. Part of this decline in here would be this down day here. And then after midnight in New York, we have a turn, short-term decline, and then it breaks market structure. So right in here, that's when your idea becomes potentially valid, because we have what? Relative equal highs here on an old daily high. So this would be like, say, I don't know, 15-minute time frame or a 5-minute chart. Okay, all of this idea. Okay, so you're visualizing what the trade setup would look like. Over time, you're going to see these recurring and repeating phenomenon in price action that are very generic to something what I'm showing you right here. If you get a break in the market structure in this low that forms in London, and we had the break in market structure that trades up into ahead of 7 o'clock in the morning New York open, then we have a decline trading down into, in this range here, if you have a fair value gap or an institutional order flow entry drill, that is an idea that would be a viable trade framework. You would expect to take a long in here, trusting that the London low will not be violated, and this down closed candle, I don't have it in here because I don't want to have too many lines that just distract you, but we would be driving into that order block here, this down closed candle, with this movement here. So that drop down, again, all this movement here, that would be potentially this down closed candle on the daily chart. So all this decline, then we have a short-term high form, and it starts to drop down. That's your Judas swing after midnight, and it's digging into the order block on the daily chart. So we're in a deep discount, knowing that we're likely to trade up into these relative equal highs because that's the same thing as this daily high here. So we're visualizing this range expansion before it forms using an intraday chart, maybe 5 or 15-minute time frame basis as being described here. So that little decline that takes place there, the pattern that you'd be looking for the framework might be a New York session fair value gap or institutional order flow entry drill. So you'd be buying in here, and your stop would have to at least refer to this London low and trust the fact that it won't likely go lower. And as it moves higher and it goes towards these relative equal highs, we would expect a great deal more expansion and speed getting up into the London close time period, which is essentially 10 o'clock in the morning to noon New York local time. And then reaching up into that buy side liquidity, smashing into that time target, buying here, getting out here with this daily chart framework in mind. So you're looking for that one particular day as a short-term trade. You can take first partial here, like it does here, and your stop would have to be kind of like where you entered, because it's a short-term trade, and then look to see if you can see a continuation with another higher daily candle. And again, trying to take something out at the next trading session's New York open and taking another large portion at the next day's London close. Okay, so the details I have here is this trade is viable if it's a Tuesday or Wednesday. Now, if that occurs and you have these signatures all here in place, it's a simple strategy. There's not a lot of moving parts, is it? Now, you might look at this and say, yeah, I can see this as you outline it and draw it out. And yeah, I can see it. I can visualize it because you're showing it to me and you're describing it. But I can't bridge that with candlestick charts, and I can't see it before it happens. And I'm here to remind you, the reason why you can't see it is because you haven't at least done this part first. You have to be able to see something that has been repeating. You only see that by going through back testing and looking for things that repeat over and over again. Which PD array makes most sense to you? The fair value gap, institutional order flow entry drill, the standard optimal trade entry with an order block and fair value gap, turtle soup, buying old lows when it's bullish at London or New York, and then looking for the same idea here, where there's buy side liquidity and a time target. You're looking for these elements here. And you also know what this is. This is a market maker buy model. Second stage reaccumulation. See how I just blended everything together? Oh my goodness, it's there. Right. I don't want you to make this endeavor too scientific. You want to try to keep it as simple as possible. Have as little moving parts as you can. And you're going to see by doing it, or at least that's the goal here, that you don't have to have like I guess the best word I could have reached for was scientific, schematic. You don't need to have that. It needs to be very simple. What is the logic? It needs to be based on something higher time frame. And what is it you're looking for as a framework on a lower time frame? And ideally, you want to be able to say what this is over here, which I've already outlined as a daily chart. And this would be like a 15 or 5-minute chart. And this is enough details here. I swear to you, this is all anybody would ever need to be consistent. You don't get a trade every single day with this. You get a trade like this once a week. And that's what I teach the folks over there on YouTube. The one setup per week, this is it. This is the roadmap for it. Very, very simple. It's one way or one route to get to that. Now, what if this over here was a 4-hour chart? Well, the same thing. Buy side up here, and you see it dropping down, and you expect the same run up in here. So your setup would be 1/3 of the time expected, but nothing really changes relative to the time of day. So even if you're not using a daily chart for your underlying higher time frame perspective, and you're using it for day trading only, or session trading, swing trading, or basically intraday swing trading, this high being targeted on a 4-hour chart still constitutes a solid move here, and it doesn't really change anything. Now, if this were a weekly chart, if this is a weekly chart and you're expecting this type of move, this here could become daily. And then you can take that and break it down into smaller fractals into an hourly and 15 and 5-minute chart too. So the more higher time frame you're going to be working as a position trader or long-term swing trader, the more analysis you're going to need to do versus intraday, which is, again, one of the reasons why I like teaching intraday, because it's right to the point, it's immediate feedback, you get lots of examples and practice on, and you don't need to have a lot of moving parts. And like I said, it gives you setups that repeat every single week. Everything here would be reversed if you're bearish. Okay, so that's one of the beautiful things about everything I do. I don't need to do the opposite side because it would be just reverse everything you see here. Now, again, what you're trying to do is visualize your specific trade framework. Now, if you're a charter member and you're trying to do this with, say, for instance, one of the price action models and using all the algorithmic principles and things, that's not what this is. Okay, what I'm showing you here is simple baseline trade framework. Can you visualize what it is that you're trying to find as setups? What do these setups look like from a generic perspective? But because of all the things that you've learned, this should be very easy to understand. You're looking at a market structure break here, and then the retracement in New York, trusting the London low, bullish market structure, draw on liquidity, higher time frame structure, that it should expand higher. So while this is going up, you're not freaking out thinking, okay, this is resistance, because retail is going to see that as what? It stopped here, and it might fail to go up there. No, we're looking for this daily chart, and you're watching that daily candle. You're submitting to that daily candle doing this, running out that previous high. You're not staring at the intraday chart. You're submitting yourself to 10 o'clock to noon time and the price over here. So it's time you're holding out for, and it's going to go above here because it's this price that you're aiming for relative to the time target here. So it's time and price. That's a complete model right there. It's over. It's done. Game, set, match, done. The only thing you need here is money management. It's a specific rule-based idea, Tuesday or Wednesday, and it's done. How hard is that? It's not hard. It's not complicated. And over time, you develop an eye for it. But you have to have a framework in mind to at least build on. And then over time, this becomes much more refined, much more detailed. There's other factors in here that you'll have in this part of the move here that you're looking for that provides confirmation, but that's not important at this stage. Everything I've shown you here is the easiest perception of a bread and butter setup that repeats every single week. But you have to be able to visualize it. Does your understanding provide you the ability to do that? Because if you have not got to this stage yet, this is where you should be placing your focus. Not anything else. Not anything else in charter membership, because you may be paid faster than you should have. If you can't visualize the framework of your trade idea that you've grown accustomed to, or if you don't have one yet, you start doing it now. Otherwise, everything I'm teaching you in 2022 is just going to feel like disjointed because you haven't done this. I know some of you are looking at this like, what's the benefit of this? I want to know where to buy and sell. And if you're thinking that, you're not going to get this because you're fixated on the wrong things at the wrong time. The answer to that question, if that's what you're struggling with, you find those answers by doing this part right here. This gets you there. Seeing the logic. What's the framework? Why that move should even manifest itself in the price action. Because if you haven't identified those repeating signatures that come together and agree, you're not going to be able to make money. You're not going to be able to find a setup that repeats. You're not going to be consistent. I'm not saying you can't indefinitely. I'm saying you can't without doing this. It gives you understanding. It gives you the approach to go into what it is you're trying to do every day, practicing, studying, looking, back testing. This is the framework. This is the thing, okay? Now, once you do this, once you've identified your framework, then you have to look at the marketplace and identify the present narrative. What's the likelihood of what you're looking for potentially even manifesting at all? See, technically, this is what it looks like. But is there a narrative in the works right now that would agree with this potentially forming? And now you have a complete model. Light bulb moment. But you have to have this part first, okay? Without having this understood and really comfortable with it. Like, you should be able to whip out a pencil and draw it out, and if you're at work at lunchtime, take your time and map it out a couple times a week until it's burned and etched into your mind. And you might have more detail than I'm showing you here, but this is all that's necessary. That's all you need. You can go back and look at the last year in trading on any pair or any market, and you'll see this thing right here forming with this logic over here, or the reverse of it for shorts. It repeats every single week. I'm challenging you. For those that have a lot of time, go back and see if you don't find 52 examples of this. One every single week. It's there every single week. Now, the range from where you would enter and where it gets the objective running out to highs and going into London, this is going to vary. That's okay. It provides you a way of trusting how long you're going to hold on to the trade because it's relative to time. You're waiting for a threshold at least getting above here because it's based on this old high on the daily chart, or 4 hour if that's what it is. And what happens if this is a hourly chart and you're scalping? Well, here's an old swing high on the hourly chart. You're expecting it to rally, and you're going to take out this old 60-minute high, right? On a 5-minute or 1-minute chart, you're seeing these relative equal highs here, which would be basically something in this hourly candle. As it drops down in here, the same premise that you're looking for that is outlined that would be otherwise a 15 or 5-minute chart. This is a 5 or 1-minute chart using an hourly chart over here as your higher time frame bias, and using this time frame over here as the higher time frame hourly. So every candle represents 60 minutes or 1 hour candle. And in the same framework here, the trades wouldn't be as much, obviously. Maybe it's 10 or 15 pips, that type of move here. But that's still enough. If you get 5 of them a week, that's still 50 pips, right? Hello. Don't negate the power of knowing what I'm showing you here, because you can make this scalable. You can make this as big as you want it to be or as micro as you want it to be. The logic is still going to be there. Why it's got to be there, why it should form at that time. Everything, think about it. It's day of the week specific. It's time of day. Targets are timed based on time and price. The logic of what is the framework behind it, and it's rooted in a higher time frame bias. The only thing it's lacking is money management. And I leave that for your own interpretation because I don't know what you're willing to risk. You don't need it to be perfect in the future, repeating every single time 100%, because that's the job of money management. But you can't allow or appreciate the effects of sound money management providing you the shield for you as a defense until you at least understand what it is you're trying to do offensively. Knowing what your plan of action is. What is your expectation in the marketplace as you as the trader? Because if you don't know what that is, sound money management can't do anything for you. Because every trade you get into will be based on nonsense without statistical probabilities behind it. You follow what I'm saying? You have to have the best of both worlds. Knowing that there's a strong probability of the market delivering like this is showing you here graphically, then having the strengths and protection of sound money management, not risking too much of your account, moving your stop appropriately, taking partials, taking a trade with less leverage because you've taken a loss the previous two trades prior to that one. The sound money management won't be able to do its job unless you have the framework of a sound trade framework. You can't have anything in you that's going to be a weakness. You have to have strengths. And the way you remove the weaknesses and the plaguing things that affect all of us as traders and speculators is you have to identify what is weak, what is sound logic, lean on those things that are sound, provide all the necessary advantages to analysis, to narrative, and risk management. Managing your money. That stage is effective only after you have sound logic that starts from here, trade framework.